Hey, welcome, Satish. Thank you for joining at 100X live show. Just to give viewers introduction on Satish. Satish Andra loves entrepreneurs with grit and clarity and focus on execution. Technology startups with clear value proposition drives Satish. His investing and co-founding leadership engineering experience in past 20 plus years in US, India, and all around technology. As a managing director at Endiya Partners, Sateesh serves on boards of Alpha ICs, Darwin Box, and Kist. Some of his past investments include Seclor, Little Eye, Facebook, M Ginger. He has many laurels, or accolades. So, Satish, welcome to 100X Live Show. Thank you so much for your time. If you
Sanjay,
can.
thanks. Good morning or good afternoon, everyone, and appreciate you having me on this show. Thank you.
Thanks. So, Satish, if you can help understand more about India Partners yourself, give some opening remarks on the current uncertainty what startup founders are facing. What would be your opening remarks and about India Partners?
Yeah, so India Partners, right from our inception and the beginning of our journey as a early stage venture capital fund, our vision has remained the same, Sanjay, which is really be the first institutional investor for entrepreneurs working on product startups. And product startups that are not just aspiring to service customers in India. If possible, they go regional and some of them go global. And our focus has been primarily in a couple of sectors. One is healthcare, and the other is technology, which today you could kind of call that as digital transformation, right? Post COVID, I think that's a very popular term that is used by everyone.
Sure.
So our model is a deep engagement model. So we would invest anywhere between $500,000 to $1 million and go up to $4-5 million per company in terms of investment. With respect to deep engagement, my partners, Dr. Ramesh, he's a cardiologist, intervention cardiologist by profession, was an entrepreneur, operating executive prior to moving to Endiya Partners, being part of this journey. Abhishek Srivastava is another colleague of mine, Abhiram. All of us have operating entrepreneurship and investment experience. So we work with entrepreneurs with respect to, kind of achieving the product market fit, hiring initial members within the team, getting the first set of customers and partners, and almost kind of fine tuning the business plan for growth capital. So that's kind of what we focus on.
Sure.
We invest in 5-6 companies a year. 3-4 years time frame, we end up investing in 18 to 20 companies, and we play a fairly active role.
Understood. So, what would be your opening remarks with this current situations where there is a lot of discussion about preserving cash and survival? Do you have any ideas to share beyond surviving? Right, we have enough and more heard across about survival, preservation of cash. What would you do more? How would you work with your own portfolio companies?
Sure. So let me kind of characterize this, this whole environment or the current setup, right, across a couple of dimensions. The first thing is what's happening out there, right? I mean, none of us have an answer, none of us have a clue as to how this is all going to evolve. It is anybody's guess, but we all know that this is surreal and unprecedented. What's happening is consumers have, income loss and also possibly job loss. God forbid that happens, but potentially, there's going to be job losses. Enterprises have very tight cash flows and shrinking revenues and profits as well. And they're going to be just focusing on their core business. And if you really look at governments, they're all busy managing the pandemic and building business continuity plans for nations, right? So that's the environment, an environment with fear, panic, and anxiety. From an entrepreneur perspective, I've always said this, whether during this time, when we are in a crisis situation or even during normal times, right? Entrepreneurship is like more a sprint as well as a marathon. You wake up and then you run very fast every morning. But that's not over. The game is not over, right? So you retire and then you know that you are in the marathon, which means you got to wake up and again run really fast. And for investors, it's a portfolio play, right? All of us go around and talk about success stories, but there are also many companies that we would have invested might not have done well, but still your winners kind of make up for your losses. But that's not the case with entrepreneurs. Because for entrepreneurs, it's kind of 1 out of 1, right? It's not like 3 out of 20 or 4 out of 20, for an investor. So an entrepreneur, whether during these times of crisis or even during normal time, needs to, make sure that they're 100% committed. They're very excited, and what they're doing, they have the conviction that they're going to get to the finish line. Nobody has any certainty, but clarity is very, very important. So irrespective of what others think, it's more about how the founding team thinks, right? Now, so that's the second dimension. Now, I've kind of gone through, as an entrepreneur, the 2000 dot-com burst and 9/11, and I was at DFJ, venture capital fund, primarily during the financial meltdown in 2008.
Yeah.
But today, what's happening, kind of surpasses everything that we would have experienced in the past. So I think what people need to look at is there's a cyclical issue and there is a structural issue, right? Cyclical, I think everybody is going to be caught. Next 3 months, 4 months, I think everybody is going to slow down. But structurally,
Absolutely.
right, after 4 months or 6 months, do you really still see, kind of headwinds? Or do you move from a neutral to, a tailwind situation? One needs to determine, and for each of these sectors and each of the companies with different business models.
That brings me to the next question, Satish. There is a big question in all the startup founders whom I talk across, and saying that will VC stop investing in startups, right? Has India Partners stopped investing? Do you guys are on a pause? Are you not investing, or in general as a VCs, would you stop investing in these times? Can you share some views on that, please?
Sure. So I think the honest answer is, I think everybody will, hit a pause for a couple of months at least, irrespective of what people say. We see some announcements that are happening now, but these announcements would be deals that people would have worked a few months ago or, several weeks ago, right, before the lockdown. So I think, what VCs are very busy doing right now is, triaging the portfolio, right? Making sure that the existing portfolio, they have enough cash, they're all safe, they're all healthy, they're motivated, to kind of go forward. So that's the first thing. The second thing that, VCs do, and you have a VC firm and you've been a very prolific angel investor for many, many years. So that, you got to update your investors, right? You got to have, an open line of communication. VC funds need to communicate with their limited partners in terms of what their strategies are. And then the third thing would be to still look at deals, because unlike the PE world or unlike, the buyout kind of funds, our horizon is going to be 9 to 10 years, right? I mean, that. I mean, in 9, 10 years, normally, or even at least 6 years, if it's not 9, 10 years, you're looking at, 6+ years. So you see a lot of up cycles as well as, kind of, the down cycles. But, you are in it kind of for the long haul. So you'll continue to look for, new set of investments. So you don't completely pause. You may pause for 1 or 2 months and you may go a little slow. But if someone was investing, we were investing like 6, 7 new deals a year, right? Or 5 to 7 new deals a year, we may end up making 3 or 4 investments, right? So that's how all the VCs would kind of approach, is what I think.
Got you. Thank you so much for that candid response, Satish. So what viewers you need to, or startup founders who are listening to Satish, VCs are open for business. There might be a temporary slowdown, but VCs are looking to invest in startups. If you guys have any questions, please post it across on YouTube, Twitter, or Facebook. It's going live everywhere. We would be picking up those questions and showcasing it to Satish very soon. Coming to next question, this whole session was about essential advice, right? What are the key questions that founders need to be ready with as an answers before meeting any VCs, right? Before they pitch to any of the VCs, what kind of questions they should be ready with? What would VCs typically ask in the first meeting, second meeting? What should they be ready with?
So, are you talking about folks who are trying to raise a new investment?
Right. Raise a new investment, especially online, right? In these times, if
Right.
a startup has to pitch to a VC online, is this
Yeah.
something different than if you are meeting offline? How does one prepare the pitch for, meeting a VC online, right? What are the ways, do's, don'ts, in your perspective? What advice and what questions startup founder should be ready with?
Again, this is not something I'm just saying now. In the current situation, I've always said entrepreneurs do a lot of diligence, right? I mean, about market opportunity, talk to several prospects and customers. They go to analysts, all of that. But unfortunately, when it comes to investors, they get tired. I mean, they end up not doing enough due diligence. And they think that every investor, so it's not a good thing, right? To raise, bad money for a good idea or kind of good money for a bad idea, right? So it's very important that just the way VCs are picky or investors are picky about choosing a startup, entrepreneurs have to be equally picky in terms of who they partner with as an investor. It's not just the money, right? So clearly, I think even previously, the questions that everybody would ask, how big is this market? Is this a real problem? And does the team have the solution? So a lot of people talk about product market fit, Sanjay, but very important is the founder and the product fit, or the founder and the solution fit. That's equally important, right? That's often ignored. And the other thing, I think today's time and age, right, a new dimension, outside of the fact that is it a real problem? How large is the market opportunity? Can the team really make it happen? Those were the normal time questions. Today, people add one more question, which is, in this current economic environment, is this necessary? And would this team have, the energy and the wherewithal, to kind of go on this journey for 7, 8, 9 years? So that's another question, right, that gets thrown in during these times. With respect to pitching online, I think a lot of calls will happen online, a lot of meetings will happen online. But my belief is that at least early stage, I don't know so much about growth or very late stage. You are investing in people. Obviously, you want to meet people. You want to sit across the table, while still maintaining social distance and masks on and all of that, right? You still need to, end of the day, have that presence. And I think that's going to be very, very important. I doubt if people are going to write, $3, $4 million, $5 million checks just after a video conference, unless they've had the past relationship, unless they've had the working relationship. So a lot of work will get done, but eventually, instead of 4 in-person meetings, maybe you may end up having 2 in-person meetings, but that's not going to be 0 is my guess. And I could be wrong, but that's how I think.
Right. So the takeaway here is still we are figuring out the ways to do a transaction online or investing commitment online. We might reach to a level where there is a genuine interest, but final closures will happen when you meet somebody offline, and this will get closed. We have got first question coming up. I'm just pushing it on your screen also. Shubham Sharma is asking, what are the main pillars when you are investing in early stage startup? Plus, does age or experience play a crucial role in it?
So I'll stick with what we do, Sanjay and Shubham. We are, like I said, technology or healthcare investors, and a lot of our investments are B2B, very select investments we've made are in the consumer sector. One is KIST in the consumer lending space, and we're also a small investor in CureFit. Those are the two consumer plays, but we're predominantly an enterprise investor. So for anybody to build a B2B product, it's very difficult for folks to conceive such a product or solution without having domain expertise. So they should have worked in that particular domain for a few years and should have understood the overall ecosystem and the gaps within the ecosystem. Sanjay, I know you build a network of CIOs, to kind of vet the ideas, especially enterprise ideas. So for us, age doesn't matter as much. I think if someone has 3, 4, 5 years of solid enterprise experience, understood the problem, we are okay with that. Even if someone is out of college, today, let's say in cybersecurity, for example, or cloud-based storage, for example, collaboration, sometimes, even fresh graduates can come up with stellar ideas, but the deep enterprise or deep healthcare, medical devices, or digital health requires domain expertise. So we're not best, but they need to have domain expertise.
Right. So that brings me to my next question, Sateesh. When you spoke about CureFit, KIST, and your portfolio companies, and we earlier spoke about the business model strength, the founder rather than product market fit, the founder, and the solution fitment. But within your examples of your portfolio companies, how would you see product market fit setting? If you can share some of your portfolio examples, how successfully you worked with the founders to get that product market fit and the business model strength, right? If you can share some examples, that would be great.
Yeah. So one of the examples, I can talk about, I'll talk about KIST as well, but in an enterprise scenario, Darwinbox, right? So Darwinbox is a cloud-based human capital management system software. It covers all key aspects of HR. Recruitment, onboarding, leave attendance, payroll, and compliance, as well as performance management, employee engagement, and then analytics. The founders came with domain expertise and background. So one of the founders, Chaitanya, was at EY, is a XLRI alum, and Rohit and Jayant, Jayant came from iBanking background, a lot of sales and business development. Rohit was ex-McKinsey and Google, and he knew the importance of human capital management. So when they had an idea, right? So you also have SAP SuccessFactors, you have Oracle, that bought Taleo, and then you've got Workday, which is a very successful company. Ex-PeopleSoft founders started this company. So they knew kind of who they were going up against. So very clearly, they had an MVP. They had set of pilot customers who were interested. So the product market fit was, the assumption was that many mid-sized enterprises in India are going to embrace cloud. From spreadsheets, they are going to go and start using SaaS software, because as they grow in size, they need to manage human resources, distributed human resources. That's very precious. And they are going to look for solutions. But from a founder product fit, I think their past experience and their knowledge of dealing with customers, they knew, where SAP would position versus where Darwinbox needs to position. So that was very clear. So you get the first 3, 4, 5 customers, work with them, make sure they're very delighted, they're using it every day, they're paying you, because it's extremely important, right? Throwing a beta product or throwing, demo or a trial subscription versus really when you transition that into a paid contract, multi-year, the real customer behavior you start to experience, because are they interested? And will they, send you a half-yearly or annual subscription check? What else would they demand? So that's where
for Darwinbox to get that product market fit and getting that scale, how much time did it took? Or did they do any change or pivot in their model to get?
No, they did not. They did not pivot. I think they have other extensions that they have uncovered, where initially they were only focused on HCM. It took them roughly 2 years, and my belief is that it will take anywhere between a year to 2 years for any enterprise company. And if it is, healthcare, more so in medical devices, by the time you have a device and then you go through FDA or CE kind of certifications, you're talking about even 2 to 3 years, right? So,
So the thing here for all the startup founders is that product market fit, please estimate around 1 to 2 years before you claim that you have a product market fit. Give enough proof, paid customers, and B2B will take more time, and healthcare will take even more time in terms of getting the product market fit. So Satish, in this whole product market fit scenario, what kind of startup which are early stage, we're still discovering across on product market fit, what kind of valuations they can expect? What are your views on startup valuation? How do you value a startup? Science, is it a science or an art? How does a VC value startup? And how should a entrepreneur or a founder pitch to a VC with saying that, okay, this is my valuation?
Yeah. No, I think it's both an art and science. From a valuation adjustment perspective, my belief is that in early stage, kind of pre-series A or series A, you may see a 20-25% adjustment on the valuation. Even before, I think, COVID-19, already, with the stress, economy slowing down, and I think, there are a bunch of companies, that have gone public, privately, they were valued a lot more than, in the public markets. We've seen that happen with Uber and Lyft. So clearly, I think investors were pushing for primarily, cash optimized business models, or business models that will, at some point of time, generate profits. So early stage valuation and corrections might be 15 to 20% range, but Series B and Series C, my belief is that it'll be more in the 30 to 40% range in terms of valuation correction. So it's both an art and science. I think, to me, in the end, it's really what a seller wants to sell at and what a buyer wants to pay, right? I mean, that's what it is. So a lot of times entrepreneurs end up going in there and saying, the market size is so much, and I'm going to have this percentage of that market share, and hence I need to be valued, so much. I think that's a very wrong approach. I think the way one should look at it is, for me to get to profitability, right? For me to get to meaningful revenue, let's say 200 to 300 crores is meaningful revenue, right? And that is like in an enterprise scenario, and you're talking about, that's not your GMV, right? That's the revenue that you get. And so a 300 crore, 400 crore kind of revenue to get there, and if it takes you 7-8 years, you also know how much money do you need to get there. What kind of sales, marketing resources, what kind of R&D, what kind of customer success.
So there's no cookie-cutter formula or a math which you can throw at getting a valuation. It's more going to be more psychological and optic driven, and basically in terms of working across backwards from a milestone basis, what milestone you want to achieve and what kind of funding you want to raise, and mutually agree upon a valuation number, right? In that's the way you are putting forward.
Yeah, but the thumb rule could be that, okay, at each stage, if you're encountering somewhere in the 15 to 20% dilution, right? That's okay. I mean, but again, as you kind of graduate to the next level, if you are a market leader, if you're a number one or number two player, then obviously you get a premium because there are many inbound requests. At that point of time, you may get a better valuation, right? Otherwise, you need to definitely do that modeling, and you need to be clear about, you get lucky. I mean, if you get lucky, that's great. You pat yourself. Otherwise, don't be too disappointed. In the end, right, I think a decent ownership, if I own, it's a question of how big is the pie. It's not about how, the piece of the pie that I own, right? Even 90% of 10 versus 9% of 1,000, it's very different. Yeah,
absolutely. So one of the questions which just popped up is, apart from experience, domain knowledge perspective, what other qualities you look for in founders? This is from Nilay Jain. If you can answer this.
So Nilay and Sanjay, again, it's very, very, very tricky. I could sit here and say anything, but I think we learn, and that's why our life becomes so much more interesting, because we don't go home saying that, oh, I've learned this all. Because early stage, when you really look at it, is the intellectual capital, it's the energy that you are investing on, right? You're investing on a potential opportunity, and the intellectual horsepower and the energy that the founding team brings to the table. So it takes few cycles, but many a times, from our perspective, these are gut-based decisions. These are not so much rationale-based decisions. You're in a room, founders come to you, they pitch, you ask them questions, they answer, their approach, the way they agree with you, the way they disagree. You form an opinion already, right? And you know that, okay, this is the team that I want to have go on the journey with. Because at the end of the day, even if
how many meetings typically you will take before you take a decision? It's not going to be one meeting where you meet and over the counter you like it and you will give it, right? While gut will tell you and give you an hunch, but definitely you will do a couple of meetings.
Absolutely. But what ends up happening is that in the initial meeting, right, if you don't like, often it ends up being a pass.
Gotcha.
Right? So whereas in the initial meeting, if you like, even if there are questions, you're working with it.
Yeah, keep on building the impression in multiple times in a positive way, which ends up in taking up, positive decision and trusting the idea and the founder.
Correct.
Yeah.
Correct.
Yeah. So we have one more question coming up. What advice would you give to startup mentors, incubators for managing young startups in these times? What should these incubators do across in these times when they are nurturing those young startups?
Sanjay, again, this is a topic, right, that we could debate, even during normal times, not just during these times, right? Everybody wants to be a unicorn, sunicorn. Now, there are articles about, you want to be a camel, not a unicorn, because, you can sustain long periods of drought without water and still get to the finish line. See, the thing is that there's nothing wrong being an entrepreneur and building a nice business, even if it's a 20 crore, 50 crore, 30 crore business, employs a couple of hundred people, profitable, delivering solutions that are of value. There's nothing wrong. You may not make it to the headlines, you may not be on Young Turks or, ET Entrepreneur of the Year. So what? You've still contributed to the economy. You've still, made this world a better place to live, and you've created job opportunities. So there is one set of these companies. There are other set of companies that grow fast, that take risk, that grow non-linearly, need capital. It's a very different kind of proposition altogether. So it's very important for the incubators and accelerator managers to decide which category do these companies belong to. Right?
Gotcha.
If these companies are companies that will grow to certain size and generate employment and add value to the ecosystem, your financing model should be very different. Whereas if there are set of companies that are fast growing, be very honest, do a very candid assessment, because at the end of the day, opportunity cost is extremely important for even all the entrepreneurs. The cost of pursuing something which is not going anywhere is very, very high, because they might lose on other good opportunities that they could have otherwise.
So we have one more question, Sateesh, that was well answered. I think a lot of insights over there. One of the stuff where due to the current scenario, many business might do business model pivot, right? Even after substantial time in business, they are forced to take a pivot. Do investors consider this as a red flag, or what would be investor view when business models pivot due to crisis?
I think it is not seen as much a red flag. It depends on the type of investor and each of the firms. I think investors are always looking, or they prefer new deals over deals that pivot. I mean, let's be very clear, right? Because in that new deal, it's fresh thinking, fresh energy, and hence, they want to go back that, as opposed to someone who's going to pivot. But if someone is going to pivot, if they have a reason And if that is something very logical, still I think people will look at the opportunity. They look at the team. They look at, is that an adjacent space that they are pivoting to, or is it completely orthogonal? And based on that, and they look at how much energy still is in the team. Based on that, they would make the decisions.
So I'll come back to questions. We have got flurry of questions coming up, but let me just because my questions are pending across since long. But if you can give, what are the three common mistakes typically you see across startup founders, making while they are pitching to VCs? Can you throw some light on that? What kind of mistakes you see across often founders make when they pitch to you?
I think the first mistake is that they don't do enough diligence about the investor or the VC firm that they're meeting. It's extremely important that they spend quality time understanding the VC firm, the team, the kinds of investments and portfolio that they have. What do they like? What they don't like? In today's world, one could go to LinkedIn and look at the activity, or go to Twitter, understand the personality of the firm or the investors, or read the blogs, or look at video sessions of the conferences. So do your homework. I think I see many a times people don't do their homework when they come and pitch. And then the second thing is, I think, be very, very open, candid, and honest. If you don't know something, just say that I don't know. So I will go and work on this. Give me an opportunity to come back to you. I've not thought about it. Right?
Sure.
That's the second thing. The third thing, I think, is primarily coming in and saying that, here is the valuation that I want, or here are the number of investors that have already said yes. So you've got like 4 hours or 6 hours or 1 week of time to make a decision. I think that move is not a good move. Even if you have investors, we would ask them, why do you want to meet with me when you already have investors, right? You should take that money and then close and go build your business. Why are you wasting your time meeting yet another investor, right?
That's it. So three things, please take away. Then this is so well resonates, which I also, when we meet across. One is do the diligence on the investor, definitely a big take. Second is in terms of don't put investors on spot in terms of saying that this is the deadline, 4 hours, 5 hours. These are great points as a takeaway for a lot of the startups, which I would take across. Now, in this current scenarios, what do you see? There are specific sectors which are winners and losers, right? And which sectors you believe are winners? If you can share some light. And what are losers? What who will get benefited with this crisis, and who is losing out?
No, I'm sure. I think everybody is following all these articles and blogs and podcasts and more webinars than we've ever seen before. So I'm sure they have the answers, but let me kind of outline my perspectives, right? I think the future of work is going to be redefined. May not be 75% will work from home, but a decent percentage of people are going to work from home. So for an enterprise to enable that kind of a concept, they have to obviously do digital transformation of all the business processes. So it would be procure to pay, order to cash. We've seen ERPs, we've seen financials, we've seen marketing. I would say, many more core business processes are going to be digitally transformed to enable, the remote collaboration. The collaboration itself among, distributed set of employees in different lines of business, marketing, sales, customer support, back office, HR, finance, executive management, they require a new dimension. So definitely work from home or the future of work is going to throw open certain opportunities. The second thing is, we all know, education, of course, is also going to go through that phase shift. Online education. We know about online, entertainment and gaming. Again, a lot of tailwinds there. Contactless commerce. I was just talking to folks and I said, hey, what if COVID were to happen 10 years from now, right? In 2030, we would have seen drones doing the delivery, autonomous vehicles coming and delivering your essential services, smart cities and smart factories already deployed, AI at work at a massive scale. So very clearly, contactless commerce is going to be another big thing. Industrial automation, healthcare, significant tailwinds with respect to medical devices, digital health. We have seen the telemedicine policy being announced in the country. That was kind of being reviewed for years, but within few weeks we have finalized and announced the telemedicine policy. So I think these are some of the sectors that will see certainly tailwinds. With respect to neutral, I think sustainability will be neutral. I mean, we've seen a lot of electric vehicles, and we have seen a lot of energy conservation technologies. I think they'll be neutral for a while before those things would be addressed. But anything discretionary commerce, I think it'll get killed. If it's to have, I think they're going to struggle.
Sure. So, Sateesh, we are running out of time. I have got one rapid fire of, kind of questions which I will shoot to you. But last one questions, if you can answer. I mean, this is extended. I'm taking more of your time, but I would love to know if you have any NT portfolio, any of your misses which you should have invested in if you missed out investing in any of the startups. Any NT portfolio story which you can share?
No, I think we keep reviewing that, right? Kind of going back and forth, and saying which of the deals happened in the market, which ones did we see, which ones did we not see, and which ones did we lose. So we're not like, okay, just because somebody got a lot of money, a lot of valuation, or even an exit, I sit there and say, oh, boy, I missed out, and I wish I had that in my portfolio. But I think, a couple of companies which we lost, I mean, after, we had an agreement or, we had reached an agreement, as a company called Zwork. I'm sure you must have heard, right? So, they're a B2B play. We lost that, right? So there are examples of companies. Another company which we really liked because of the impact, it's a telecardiology company, right? So today what happens in remote places, people, when they think they have gas pains, actually they have heart attacks. Or when they think they have heart attacks and rush to emergency rooms, they really have gas pains. So there's no remote diagnosis of cardiology problems. And so using technology, if one could do that, I mean, that would create significant amount of impact. That's another company that we couldn't be part of the journey. So we have companies like these where we might have lost out or have not invested. Not that they're spectacularly successful today, but still we feel that those are the investment theses that we like, and we don't feel good that we missed out, those.
So coming to rapid fire, and then we'll pick some questions. You have got only max 5 seconds to answer whatever top of the mind comes across.
Okay.
Right. So you are on a spot now. So let me start with it. Name the top 3 VCs of India. Which are the top 3 outside of Endiya Partners? I'm sure you are there, but top 3 VCs which you believe in.
No, we're not there, right? So I think if it's by deal volume and brand, I think it is
in whatever the case, whatever recall you have.
So my answer is going to be deal volume and brand. It's Accel, Sequoia, and Lightspeed.
Okay, Accel, Sequoia, and Lightspeed. Name 3 startups that would become the next unicorn outside of your portfolio, where you believe they have a potential to become unicorn. 3 startup names that should become next unicorns in India.
I have no clue.
No clue. Okay.
And I don't follow, as I said, and look at which ones are going to be unicorn.
That's fine. If you had money to fund this time and invest in OYO rooms in current times, would you invest in OYO rooms if you had that money?
No, I mean, that's not a sector we are active, so we would obviously not.
You would not invest. Okay. Which city in India is the startup capital of India, and why? 60 seconds max.
No, I think it's Bangalore. Obviously, if you look at other side of tech and healthcare startups, Chennai, Pune, Hyderabad, are all kind of.
Your first recall is Bangalore. Who is your ideal fund manager? Name a fund manager in India and globally whom you believe is a great fund manager in India and globally.
I love first round VC.
Fund manager name, please.
Oh, you mean fund manager name?
Yeah.
Fund manager. So I was more talking about the firm. If it is a fund manager, I definitely love Ben Horowitz.
Ben Horowitz globally in India.
Ben Horowitz. Yeah.
Yes. And Ben Horowitz and in India, fund manager.
No, I mean, there isn't any one particular person that I like or dislike.
Sure.
Yeah.
Would you have time, another 5 minutes to take a couple of questions, Satish, if I may? More time yours. So we have one question which is coming up. How much early traction is important in this phase? Can you share some insight? What kind of traction a startup would be before they pitch to VC?
Yeah. Again, Sanjay, this is very different for each sectors, right? If you're talking about a SaaS company, you need to have an MVP and you need to have a couple of paid pilots, at least. That becomes very important. So simple wireframes today will not get you the money, or an idea will not get you the money. You need to have a couple of paid pilots and an MVP kind of a product. And if it's something like a digital health or a medical device, or even let's take AI company, you need to have the core team. You need to have at least the basic tenets of technology and certain customer endorsement. It all depends on the team and their background and the relationship they would have with that first investor who's going to write check. Right.
Great.
That's
question. Satish would be from Pratik Bhaskar. What do you think of future of agri-tech startup? What's your view on agri startups?
I think there's tremendous potential, but there's also equal amount of noise. If you really look at even now, state governments are obviously looking for solutions. As state governments, they are looking for solutions because farmers have harvested their crop and they want to connect with marketplaces. And we've seen, today because of issues with logistics, how folks are struck. So combination of technology plus market forces would make this sector very, very attractive, and you're going to see lots of investments happening.
Okay, cool, fantastic. Agri-tech, thumbs up from Satish. Do you recommend patenting early, or maybe will there be a need of a patent at an early stage? What's your view on patents within startups? That's from Somnath Ukil.
Yeah, so I think patents are very important, but you also should not give away too much. If it's really precious, I think you should hold on till you get closer to realizing your product, so that you have certain advantage in terms of time, before the competitors kind of catch up. But it's very important. You should go for it.
Sure. Sandeep has on the single founder investment, right? A single founder to raise money. What's your view on single founders?
It's tough. It's very, very tough.
It's very tough. Great. What is the best time to launch an FMCG beverage brand? Would you have any comments on this?
No, I'm a wrong person to answer that.
Okay. Yeah. Fitness and wellness industry, is it going to get affected?
I think it'll get affected quite a bit because physical centers will find it very difficult because of the lockdown and the physical distancing and social distancing norms. I think online, will pick up, but there's also equal amount of noise. So how would one really be different from all other even free offerings? One have to define, if they're going to monetize their offering online.
How important is full stack business, offline, online? Do you believe it should be a full stack business?
I don't know what is full stack, Sanjay. I mean, if you can, demystify what's full stack.
So typically, let's say if you are doing a QSR, you own the kitchen, you own the delivery. I mean, there are people who would just do one part of the business rather than doing the whole part of it, right? Yeah. So that's where we'll move to the next one. If someone is creating social network platform, does experience matter?
Not really. I think it's about virality. How soon can you get to 50 million or 20 million people using your network? I think it is all dependent on the significant traction, and the traction is very differently defined for networks.
Yeah. So I think we'll close this here. I've taken your extra 15 minutes outside of 30 minutes. You were so kind. Thank you so much, Satish, for this. Any closing remarks before we end the broadcast?
No, I think thanks again for giving us the opportunity. I think every crisis, brings out real winners because people go back to drawing board and you have time to reflect. So, wishing everyone the very best. While in the next 1 2 years, we'll see certain slowdown in the startup ecosystem and the quantum of funding and the number of unicorns or sunicorns and all that. But for a healthy ecosystem, to prosper over a period of time, you got to sow the seeds and you got to really fund right sets of companies, that have unique solutions. And my belief is that India's time is now, and a lot of innovation will happen. So I wish everyone the best.
Sure. On the if a startup founder has to reach out to India Partners, what is the best way to communicate?
I think we have our contact information on our website with the email ID, and we do read. We may not reply all emails, but we do read the emails. And the ones we're interested, we do get in touch.
Okay, awesome. On that positive note, India Partners does read all the emails, and whatever you will write across will be seen and screened. Thank you so much, Satish, coming on 100X Live Show. Appreciate your time, extended time. Thank you. Thank you so much.
Thank you, Sanjay.